So in a previous video, one of the things that I mentioned is that the way that the Federal Reserve conducts monetary policy now is very different from how I taught you they conduct monetary policy. The problem here is that College Board has not kept up with the times. Some of it you can't really blame them for. For example, there are a couple of changes that are 2 months old. For example, savings account, which used to be an M2 or actually an M1, and they really don't care about M1 and M2 as much, and we'll talk about Phillips curves later and how those aren't really used anymore either. But some of the stuff goes back to, around 12 years ago. Some of it's 5 years ago or so. Old enough that AP should have updated the AP macro curriculum for to take account of the changes, and they haven't done that, but here we are. So this is frustrating to me because I'm stuck between teaching you how to do well on the test or how to actually understand how monetary policy works. Because the way that I taught you with those 3 tools, right, I talked about the discount rate and reserve requirement and open market operations as being the primary tool of monetary policy, all of that is historical now, right? That's historical economics, basically, right? Something that belongs in a U.S. history class instead of actually a current economics class. Okay, so I'm bothered by the fact that they haven't updated it, and so I have to teach this stuff which is really obsolete and out of date, and trying to get you to understand how things actually operate. So I'm trying to balance here and do a little bit of both. So the stuff that I taught you before, right, about those 3 tools and with the money market and the loanable funds and all that stuff, that's all for the test. So bear that in mind, that is for the test. All right. What I'm going to be talking about in this video is how it actually works nowadays, right? The current stuff. Okay. So the Federal Reserve has this dual mandate, and it used to be a triple mandate, right, where it was maximum employment, price stability, and low long-term interest rates. And honestly, the old stuff is still there. One moment. The old stuff is still there, but we really broke it down from 3 to 2. So now instead of having that third one, low long-term interest rates, they don't really talk about that as being a separate third one, and the reason is that it really is incorporated into the other 2. All right? So if you are aiming for maximum employment and stable prices, then low long-term interest rates will come along as part of the process. All right? So this is what the Fed is trying to do when it is using its monetary policy is maximum employment, so trying to get us to full employment output, so no cyclical unemployment, and then having stable prices, okay, which they look at trying to achieve 2% inflation per year. Now, 0% would be nice, but it's difficult to hit, and deflation is really bad. So if you give yourself 2% inflation, you've got that 2% buffer to be able to work with. So in case you're a little bit off, you're not going to get it drastically wrong and go all the way to the deflation route. Okay? But the Fed is trying to achieve these 2 goals, and these are statutory goals. So these are the goals that Congress has set for the Federal Reserve. It's not goals that they have for themselves. I mean, they do, but they didn't make them up. Congress gave them these goals. So this is what they have to achieve by law. All right? So you got the FOMC, which is stuff that we've talked about before, the structure of the Fed. You got the meeting room for the FOMC meetings in Washington, D.C. All right, and this is a summary of how it all operates, right? And this is something we've kind of gone over in the past. That box 1, the FOMC, sets a federal funds target rate. So this is where the FOMC has their meeting. They decided they're going to do expansionary, contractionary monetary policy, basically. Right? Stay the same, do expansionary, do contractionary. Which one should we do? Right? Do we want to raise interest rates or lower interest rates, and by how much? Okay? So they have their meeting. They decide where they want the federal funds rate to be. Right? Remember, the federal funds rate is the interest rate at which banks borrow from other banks. And this interest rate affects all other interest rates in the economy. If we're talking about the mortgages, car loans, business loans, whatever. All right. Now, the FOMC meets and they decide they want to keep the federal funds rate within a particular range. Usually it's a quarter-point range where they say we want to keep it within, say, a quarter point to half a point of interest. Okay. Or they want to raise it to 1 to 1.25%. And they'll talk about basis points. So they'll talk about 100 basis points, which is just 1% interest, or 125 basis points, which is 1.25%. All right. But they'll set the range, right? Now, the way that they used to do this is they would set the range and then they would use open market operations and they would buy and sell bonds. And they would buy and sell bonds on a daily basis to make adjustments, right? So you think of the money market graph that we had where you have the interest rate versus the quantity of money, all right? So they're constantly manipulating the money supply, increasing or decreasing the money supply in the system in order to try to get the federal funds rate about where it is they want it. Right? The Fed funds rate is a market set rate. It's a matter of supply and demand. The supply of loanable funds, more or less, versus the demand for those loanable funds within the banking sector, right? So how much money is there to be loaned out versus how much do banks want to be able to borrow the money from other banks, right? So it's set by the market, but the Fed manipulated it through open market operations, right? Adding money to the supply of loanable funds or taking it out, okay? So that was how they used to do it, but they don't do that anymore, right? But this is the process they have here, right? So they set where they want the federal funds rate to be. They have the policy implementation, which is where they manipulate the federal funds rate. The federal funds rate affects all the other interest rates within the economy. Those interest rates will affect consumers and businesses' decisions when it comes to spending. And then you get towards maximum employment and stable prices. All right. So in a recession, the FOMC would lower the federal funds rate. They'd implement the policy through its various tools. The federal funds rate would fall, which would lower all the other interest rates within the economy. Lower interest rates compel consumers and businesses to spend more. The more spending would shift aggregate demand to the right and get us towards, or at least closer towards, maximum employment and stable prices. Okay. If we were facing an inflationary economy where prices were going up, they would do contractionary monetary policy. So they would want to lower the federal funds target range. They would implement it with their tools. It would raise interest rates. Okay, higher interest rates would make consumers and businesses spend less, and then we would again get back towards maximum employment, stable prices, or at least keep us from inflating out of control. Okay, so it's this area here in the policy implementation that we're really talking about. How is it that they adjust the federal funds rate? Okay, now it used to be primarily through open market operations. And then you have the other tools, discount rate, and you also had reserve requirement as supplementary tools that they could use to try to achieve these goals as well. All right, but those tools are not the same ones in the box anymore. All right, so I'll just go through the slides here. This is from the Federal Reserve Bank of St. Louis, economic education. It's a nice PowerPoint, so I'm using it here. They give it to teachers for this sort of thing. So here are all the slides. You can pause and look at the text if you want to. All right, this graph right here shows you the target range going back to January of 2018. So the gray bars indicate the target range that they were going for, right? So here are the basis points, percentages, right? So right now it's between 0 and 0.25%. Yeah, and then you see where it's been in the past, right? So this would be like 1.4 to 1.6, 1.6 and 1.8. So the gray bars show you within the quarter point range that they want the federal funds rate to be. And this shows you where it actually was, right? So the red line is the actual federal funds rate, and you'll notice they've been pretty good about keeping Fed funds within the target range that they want it to be, right? So at each step of the way, even really drastic moves, right? You see how much they dropped the target rate here back when the economy was going downhill with the early pandemic. Right. So you see how much they were able to lower the target range and how the Fed funds rate actually followed that, right, very nicely. And so we're going to talk about how it is that they now manipulate it, right? the tools that they actually use. So those old tools that we talked about, the discount rate, it's there, but kind of in a different manner. Reserve requirement is gone. They don't use the reserve requirement as a tool anymore. In fact, the Fed is trying to get economics professors and textbook manufacturers at both the high school and college level, and trying to get AP, right, College Board, to get rid of the whole reserve requirement stuff because it's not in use anymore. In fact, the Federal Reserve, it used to be that the reserve requirement was at 10% for the longest time. They lowered it to 0% because they don't need it anymore. It's not serving a function any longer. Right? Now, it used to be they needed the reserve requirement because they needed to prevent banks from loaning out all the money that they had on deposit. But now, because of the way the Federal Reserve operates with interest on reserves, which we'll talk about here in a second, they don't need to do that any longer, right? Banks will voluntarily keep reserves on hand because they can profit off of it instead of being statutorily required to keep a certain percentage of reserves on hand like they used to. Okay? So the reserve requirement is now 0. It's not there anymore. It's not a tool at all. Okay? And open market operations is also still there. However, it is now a supplementary tool serving a very far different function from what it did in the past. Okay? So these are the new tools that we have. Right, interest on reserves, which we'll talk about here in a second. Overnight reverse repurchase agreement facility, which we'll talk about also. The discount window or the discount rate. All right, and then open market operations. So from these first three over here, we get these administered rates. And what we mean by administered rates is that these are interest rates that the Federal Reserve sets. It's not manipulated rate, right, like the federal funds rate where they manipulate the market to try to get it where it is they want. These three rates, the Federal Reserve just straight up says what they are, right? So they set the rates and dictate what the rates are going to be. Okay, so this is what we mean by administered rates, all right? Well, so it used to be, the Federal Reserve, let's say they want to do expansionary monetary policy, they would buy bonds on the open market, and then buy bonds, right? So make the money supply bigger, right? Buy bigger. So they'd buy bonds, right? The bonds or the money would now be out there in the public, and that money would wind up in the banks, right? Or be bought directly from the banks, right? So excess reserves build up at the banks, a bigger supply of loanable funds. Banks lower their interest rates to get people to borrow the money, and so this is how it would go, all right? So open market operations would be the big way they would manipulate the federal funds rate, and they would wind up changing open market operations, buying and selling on a daily basis, trying to manipulate that federal funds rate and get it where it is that they want. All right? But again, that's gone. That is what was known as the limited reserves regime, right? Where banks could keep on hand a certain percentage, like 10% of deposits on reserve as required reserves. The rest of it became excess reserves. They could loan it out, right? And it was in a bank's best interest to loan out all their excess reserves because that would maximize profit. They'd be able to make the most money off of it if they loaned out all the excess reserves, all right? But things work differently now, right? And it has since the financial crisis in 2008, 2009. This is what brought about the change. The government gave the Federal Reserve the ability to give interest on reserves that banks keep in their accounts at the Fed. All right, because remember, the Fed is the bank for banks. So banks have bank accounts at the Fed, just like you have checking accounts at, your commercial bank. Those commercial banks, in turn, have kind of the equivalent of checking accounts at the Fed. Okay. And now, it used to be those reserves that were kept at the Fed got the bank nothing, right? However, now, the reserves that are kept at the Fed, that gets them interest overnight. And so this is why we don't need the reserve requirement anymore, is because banks voluntarily hold on to reserves because it produces profit for them through the interest on reserve balances. Okay, so on this crazy new graph here, this is kind of what this is showing, right? So the x-axis is reserves, the amount of reserves within the Federal Reserve System, right, that are kept there. Yeah. This is interest rates. This is what the y-axis is, basically just interest rates, right? And so the supply of loanable funds, the supply of money right here is set by the Fed, right? So this is the supply of money out there, and the Fed can manipulate this to be wherever it wants to. That's why it's a vertical line. These interest rates over here. Okay, so we have the discount rate. Okay, remember the discount rate is the interest rate at which banks can borrow money from the Fed. Yeah. But they don't want to borrow money from the Fed. Banks want to borrow money from other banks, and they borrow it at the federal funds rate, which is this guy down here. All right, this red line is supposed to be representing the current federal funds rate, the interest rate at which banks borrow money from each other overnight. Okay, now, this IORB rate stands for Interest on Reserve Balances rate. This is the interest that banks can get on their excess reserves, right? Or I guess it's all reserves now. We don't even talk about excess reserves any longer because there's no reserve requirement. So there's no excess. It's just reserves, right? Money that the bank has, hasn't been loaned out. So the reserves that banks have, they can put it in their Federal Reserve accounts, their accounts at the Fed, and the Fed will pay them interest on those reserves. And the interest is this. This is the interest rate that banks will receive when they keep reserves in the Federal Reserve System. Okay? Now, I'm going to ignore this one down here for a moment. What we see is that the rate here tops out at the discount rate. Okay? Since this is the top rate and this is the lender of last resort rate, banks are never going to wind up charging more or being charged more than this rate to be able to borrow money. All right. This is the highest rate possible for banks to be able to borrow money. It won't get any higher than the discount rate. So you see the demand for reserves, right? In this case, the demand for being able to borrow money, right? Borrow reserves within the banking system. All right, other banks borrowing money from banks. You see it topping out here at the discount rate. Okay, it won't go higher than this. Banks will never borrow money at a higher rate than the discount rate because the Fed is the lender of last resort. Okay. Now, you see that very drastically, as the interest rate falls, right, you see this going down quite a bit, right? So as interest rates fall, banks have an incentive to not keep stuff on hand, not keep reserves on hand, but to be able to loan it out. So you see it falling drastically here. Okay. Now, the IORB rate, the federal funds rate, the demand for reserves in the banking system, all right, you'll see right here, goes below the IORB, but it doesn't go very far below the interest on reserves balances rate. And here's why. If you're a bank, all right, you've got reserves, you've got this money sitting around, you can either loan it out, you can loan it to other banks overnight at the federal funds rate, okay, or you can store that money in the Federal Reserve and get paid interest on it while it's in the Federal Reserve. All right, let's try this again. A little technical problem there, glitch. All right, so banks can keep reserves at the Federal Reserve, all right, in which case they earn the interest on the reserves, or they can loan it to other banks at the federal funds rate. All right, one or the other. Now, it makes sense that the federal funds rate is going to be below the interest on reserves rate. Okay? The Fed funds rate won't be above that, and here's why. I'm going to fast forward through some of this here. All right? Well, let's say this is our situation, right? So the IORB rate is going to be at 2.5%. All right, so this is what the Fed has set it at, is 2.5%. So saving at the bank, 2.5%. All right, or the current federal funds rate is going to be 2%. This is if they loan it to a bank. This third option could be another way that they can make money also, is investing in treasuries. We'll leave that aside. So deposit at a bank at the Federal Reserve at 2.5%, or they can loan it to another bank at 2%. Well, what's going to happen? There's a little bit of a risk loaning it to another bank. If they deposit the money into the Federal Reserve, there's no risk at all. They're going to get paid that interest on reserves balances rate, the IORB, and they'll get it regardless. Now, this thing called arbitrage, right? Arbitrage is simultaneous purchase and sale of funds or goods in order to profit from a difference in price. This is you buy something and then you immediately sell it, right? So here, what would happen, all right, if it was 2.5%, again, the IORB, federal funds rate is 2%, all right, well, if this is higher than this, if you're a bank, you've got a pretty obvious choice here. You borrow money at the federal funds rate at 2%, okay? You're the bank, so you borrow from another bank at 2%. Then you turn around and you deposit that money into the Federal Reserve accounts at 2.5%, right? So it's pretty brilliant. You're going to make money simply by borrowing here and then basically depositing it here. The next morning, you get paid back the 2.5%, right? And then you pay back the original bank at only 2%, and you got that 0.5% difference, right? That's your profit, right? 50 basis points, okay? But when this occurs, this will start driving up the federal funds rate, because as more banks try to borrow from other banks, it increases the demand for these funds, right? And a bigger demand, right? Think about demand curve. If demand curve shifts to the right, that increases the price on something. So the demand for these loanable funds increases the price, which is interest rates, federal funds rate, and it will start going up to 2.5%. Okay. Now let's say that it starts going above the 2.5% of the IORB, right? The federal funds rate goes above it. Let's say it goes up to 3%. Well, what's going to occur then? The reverse process. Banks will pull their reserves out of the Federal Reserve and they will try to loan it to other banks. The supply of loanable funds, for this purpose anyway, will increase, right? But as the supply of this money to be loaned out, the supply of loanable funds increases, that will start to drop the price. So the interest rate will start to go down. So this means the Federal Reserve rate, the federal funds rate, is not going to go above the IORB rate. Okay? In fact, it should hover somewhere right around the IORB rate, right? So anytime the federal funds rate starts to go below it, then it should go back up to the IORB. And anytime it goes above it, it will go back down to the IORB. Okay? Now, the reason that it actually goes a little bit below is because banks are not the only institutions in finance world that is able to borrow money at the federal funds rate. There are other institutions also, money markets and stuff like that. These are not depository institutions that can deposit money in the Fed and earn interest in the way that commercial banks are able to. So because you wind up having these other entities that can borrow at the federal funds rate, borrow from banks at the Fed funds rate, this means that the Fed funds will actually be able to go below the IORB rate, but not too far below, right? And we don't want to go exceptionally below either. This is where the Fed created this other thing, the overnight reverse repurchase agreement rate, okay? And so this was started back in 2014, 2015, I think it was. And this is kind of an interest rate that is charged to other financial entities, right? These other ones that could use the federal funds rate, but can't deposit money into the Fed and earn interest in the same way. And what happens with the overnight reverse repurchase rate is that these other entities, whether they be money markets or anything else, they will loan money to the Fed more or less, and in return they get collateral, right? And the collateral is in the form of a special security that the Fed issues to them, and it is good for overnight, more or less. The next morning, the entire transaction is unwound. This is the overnight reverse repurchase thing, all right? So the Fed will rebuy that security, that collateral, think of it as being like a document, from this financial entity, and when they repurchase it from the financial entity, they pay back the original price plus a little bit of interest. So you want to have the same arbitrage process that would happen here, all right? Where that will mean that this creates kind of a floor, right? Where the federal funds rate is not going to go below this on RRP rate, because otherwise financial entities would manipulate it, right, to take out at the lower rate and then rebuy at a higher rate. Same thing as what happened up here. So this creates an absolute floor where not even these other financial entities will go below this when it comes to the federal funds rate. Okay, and then the IORB rate creates kind of a ceiling where the federal funds rate can go below it but not above it. Okay, so the Federal Reserve is able to manipulate the federal funds rate by fixing these three rates. These are administered rates. They can set these into be whatever it is they want. All right. So they can raise or lower all of them in concert with each other. They'll raise or lower all three of them by the same amount, and then that will make the federal funds rate be sandwiched in between the two and move up with them. Okay? So if the Fed is engaging in expansionary monetary policy, it wants to lower the federal funds rate. So let's say it wants to lower the federal funds rate by 0.25%, right? So it'll lower the discount rate by 0.25%. It'll lower the IORB rate by 0.25%. It'll lower the on-RRP rate by 0.25 points, right? And so when they do that, the federal funds rate will then adjust to being sandwiched in between, right? And will also go down 0.25 points, right? And so that goes down, and then the lower interest rates within the economy create more spending in the economy, which increases the aggregate demand, it shifts right, etc., etc. If the Fed wanted to do contractionary monetary policy and raise the Fed funds rate, they would raise all three of these, right? Let's say it wanted to raise it 1%, right, 1 point. So 100 basis points. It would raise this one by that much, this one by that much, and then this one by that much. And the federal funds rate would stay sandwiched in between the two and go by the same amount. Okay? Now, what this also means is that because they're able to sandwich the Fed funds rate in between these two rates, the supply of money within the economy isn't as important as what it was before. Before, when we looked at the money market graph, it could have a very sensitive effect on interest rates. Now, in this ample reserves regime, all right, it doesn't matter as much, right? As long as the reserves within the system are ample, the Federal Reserve can make little tweaks here and here to the supply of money. It can even make large chunks, and as long as we're still out here on this plateau, it will not change the federal funds rate, because the federal funds rate is going to stay sandwiched in between these, so therefore the supply of the money, it doesn't matter nearly as much as what it did before. And so this is important because this is how the Fed exercises monetary policy now. It's this that is the big tool now, not open market operations. Open market operations only sticks around now as a way to preserve ample reserves within the banking system. Because the demand for cash increases a little bit every year. So if that wasn't being the case, in order to satisfy the demand for cash, banks will take money out of their reserves and convert it into cash. And that would decrease the amount of reserves in the banking system. So the Fed just has to be able to keep enough, right, ample reserves, so they'll increase the money supply enough to keep those reserves ample within the banking system, right? So they can make changes here, but as long as they're on the plateau, it won't make a whole lot of difference, right? So the open market operations is just there to keep the reserves ample, but it doesn't serve a daily function like what it did before in trying to manipulate the federal funds rate. Okay, so this is how the Fed does monetary policy now, and honestly, it changes a lot of stuff. It used to be assumed that, well, if we put more money into the system, it's going to create inflation, right? It's going to tank interest rates, create a whole lot of spending, and create a whole lot of inflation, and that's not what we've seen. If you look at the historical data over the past 12 years or so, since the financial crisis of 2008-2009, gosh, the money supply over the past 10 years has increased by 46%. And yet the average inflation rate, if you look at CPI, each year has only been 1.7%, right? People were really worried about 12 years ago that the Fed was increasing the money supply so greatly that we'd see massive inflation at some point. And it simply hasn't occurred. And one of the reasons is because of the way they exercise monetary policy. And there might be other stuff now, but our assumptions about the way that it operates and how it will affect prices is not quite the same as what it was before. Monetary policy through these tools is operating differently. Better than what it did before? I don't know. It could be that we've just opened up different cans of worms that we've yet to fully realize. Sometimes you change things, you get good parts, and then bad parts happen also. All right. This is all stuff we talked about, right? If you want to pause and look at what was on each one of the slides, right? Primary tool, right? Reservation rate. etc., etc. Blah, blah, blah. Yes, all that stuff we talked about. Alright, so this stuff. Yeah, the overnight repurchase facility, reverse repurchase facility, we talked about that. The discount window, right, it's there. It creates the absolute ceiling on interest rates when it comes for banks borrowing. Open market operations just preserves the ample reserves. Yep, and we talked about this, how they'll raise and lower it, etc. Yep, so this is what the Fed does nowadays. And it's important for you to realize this and how it is that it operates now. How we're teaching you for the purposes of the test is, again, historical economics. Not what we do nowadays, not what the Fed does nowadays. It's completely different. So at least now, if you've actually sat through this, you know how it is that the Fed actually does things. If you go on to further economics or a further economics course, you'll be ahead of the game, because everybody else would have learned the old obsolete way, because that's what everybody else knows, but this is how it actually goes.